This is a bookable summary of the book, Warren Buffett's Ground Rules, by Jeremy C. Miller. Are you looking to get rich on the stock market but finding it more difficult than it looks? Well, you're not alone. Even the richest person in the world, Warren Buffett, didn't get there overnight. But the good news is that he left behind some valuable insights that can help you on your journey. In this video, we're going to take a look at Warren Buffett's investment advice straight from the man himself. Back in 1956, he started writing reports to his partner, detailing his views on the market, predictions for the future, and his investment ethos. And lucky for us, he compiled 14 years worth of these reports into accessible and humorously written letters. So, if you're ready to learn from the best and start your own successful career in stocks, keep watching. Who knows, with some consistency and a little bit of luck, you might just get rich too. The secret to Warren Buffett's success: patient investing. Have you ever wondered how Warren Buffett became one of the richest people in the world? The answer lies in his investment strategy: patient investing. In this video, we'll reveal the basic rule that Wall Street types don't want you to know and show you how careful investment, not frenetic speculation, is more likely to create value. Investing is not rocket science, but it can be confusing. Many people confuse speculation with investment. Speculators obsessively follow unpredictable market fluctuations to buy and sell stocks hoping to get rich quick. Investors, on the other hand, buy businesses based on a careful assessment of their inherent value, and then they wait. Warren Buffett is an investor, not a speculator. He attended business school in New York, but his methodical, straight-talking approach characterizes his investment philosophy. Inspired by his mentor, Ben Graham, Buffett figured out that the prices of most financial assets, like stocks, eventually fall in line with their intrinsic values. When you buy a stock, you're buying a tiny fraction of a business. Over time, the stock price changes to reflect how the business is doing. If profits are good, the business's value grows and the share price increases. But if the business loses value, the share price falls. Sometimes, the stock price doesn't accurately reflect the value of a business. Investors who buy shares in undervalued companies, then patiently wait for the market to correct itself, can't help but make money. The key is to focus on what the market should do, not when it should do it. Trust that the market price will eventually reflect the actual value of a business, and you can expect to eventually make a profit. This will help you avoid selling just because the market dips. And this patience rewards you with compound interest, which is the key driver of value over long-term investments. Buffett's favorite story illustrating the power of compound interest involves the French government's purchase of the Mona Lisa. King Francis I paid the equivalent of $20,000 for the painting in 1540. If he had instead invested the money at a 6% compound interest rate, France would have had 1 quadrillion by 1964. So, are you convinced of the power of investing? In the following blinks, we'll show you how to develop your own investment style. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. The one habit successful inventors swear by: compulsive measuring. We all know that Warren Buffett is one of the most successful investors of all time. And one of the secrets to his success is his habit of compulsively measuring. He knows that careful measurement, clear-eyed analysis, and a steady hand, even when things aren't going well, are the only ways to succeed as an investor. But we understand that measuring your investments can be stressful, especially when you're not doing well. However, to achieve a level of success that Warren Buffett has, you need to get over those anxieties and start measuring your investments every day. In this video, we'll give you some tips on what to measure and how to do it properly. We'll also discuss how you can measure your results against past performance in the market and why index funds are a great option for those who don't have the time or energy to devote to their investments. Investing in undervalued companies. If you're a young investor trying to figure out your investing style, Warren Buffett has some valuable advice. Firstly, it's important to develop your own style that suits your goals, funds, and competence set. Don't try to invest in industries you don't understand just because they seem lucrative. Instead, focus on companies you believe are undervalued, which Buffett calls generals. New investors with less money have an advantage over those managing huge funds because they can invest in small companies not listed on the stock exchange, which can result in big percentage gains. Buffett started his fund with just over $100,000 and attributed his early success to his focus on small, relatively unimpressive investments. Buffett's investment strategy involved buying generals, fair businesses at wonderful prices. These were companies of middling quality but priced under market value. He also liked investing in nets, companies that were worth more dead than alive. These types of investments are not glamorous, but they have done the best in terms of average returns. As Buffett gained more experience, he transitioned from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. He also started looking beyond cheap stock prices toward the quality of a business and whether its earnings could be sustainable. If you're more experienced and want to get involved in the management of one of your investments, Buffett suggests having some further guidelines. But for now, focus on finding undervalued companies and sticking to your own investing style. Big profits through risky business, arbitrage and controls. Warren Buffett's first experience with arbitrage involved buying and selling Coca-Cola bottles to his friends as a kid. Today, he still uses arbitrage as a way to bet on a company's future value, but with much higher stakes. While the returns on such bets can be very attractive, they also come with great risk and require intimate knowledge of the businesses and markets involved. Merger arbitrage, in particular, was one of Buffett's specialties in his early investing career, but it's usually not recommended for the average investor unless the deal is in their specialized field and they've studied it inside and out. For those who don't want to mess with arbitrage, Buffett recommends buying a large enough piece of a company listed on the public stock exchange that you have the right to influence how it's run, known as controls. However, these deals can also lead to confrontations and messy situations, which is why Buffett stopped getting involved with controls as he matured. Instead, he stuck to his core investment principles of careful analysis and a steady hand approach. In this video, we'll learn more about Buffett's successful investment strategies and how you can apply them to your own investments. Invest like Warren Buffett, stay true to your principles and don't follow the crowd. One of Warren Buffett's core principles is staying true to your investing principles, even when the market seems to be going in a different direction. You see, following the crowd is not always the best strategy when it comes to investing. The majority may not always do better than the average, so it's important to train yourself to go against the crowd. Buffett's investment style reveals that you should only invest when you totally understand the whole picture and the best course of action. Buffett's approach has always been cautious, even when the stock market was generally considered to be too high. He knew a correction was coming, he just didn't know when. Meanwhile, other investors, like Jerry Tsai, were making big money with their speculative investments. But Buffett remained convinced that it wouldn't last. When the market reached a new high in 1966, Buffett finally acted. He announced that he wouldn't be accepting new partners and halved his performance goal. This move paid off, and his fund continued to do very well, but he knew when to fold his hands and take his money off the market. On the other hand, Tsai's end was imminent, and he ultimately saw it coming too late. He sold his fund at just the right moment in 1968, but his investors lost 90% of their portfolio assets in the early 1970 market crash. So what's the lesson here? Your methods may change with the market, but your core principles should stay the same. Figure out what you believe in, and when the right opportunity comes along, bet big. With Buffett's courage of conviction, you almost can't lose. We hope this video provided valuable insights and information for you. Which Warren Buffett investment strategy do you think is more effective? Patient investing or compulsive measuring? Let us know in the comments. And if you learned something new in this video, make sure to hit the like button and subscribe for more videos. Thank you, and until next time.